Hey guys, how's it going? I hope everything is going well. Now I wanted to do a video on crude oil and let's go to CNBC's website if it ever decides to load. Okay, here it is. Okay, right now it's on what 10-15 minute delay. It says 59.74, but if you're paying attention to the price of crude this morning, it was up only like what 29-30 cents. And there was a pipeline blast in Libya a few hours ago, which had a short squeeze in the price of crude, which got it to 59.74. And I talked about crude, I think, a few months ago, a month and a half ago, and I talked about how I felt that this would be rallying down hard, probably to the low 50s at least, and high 40s. And the reason why I thought that was you had high positioning in the commitment of traders, indicating that these producers were very net short. So you don't want to bet against them when they're very net short. But that doesn't stop hedge fund types in speculating that these prices are going to go higher. And there was a good reason to even speculate that these prices would get higher, because you had the tax cuts coming into fruition, and you are right now going to have some inflation because of that, and also with these rate hikes that I've talked about that are inflationary. Now I wanted to go to this site. It's called Free CoT Data. Like I was talking about the commitment of traders, you could see over here the green indicates the producers and users, and the speculators over here in this bluish color, turquoise color, whatever you want to call it. So his data is a little different than what I look at. He must be looking at the non-legacy commitment of traders. I look at the legacy format. There's two formats. Ultimately, I look at commercials versus non-commercials. And in this format, it breaks it down between producers, money managers, speculators. So in the speculator category, you have the money managers. But as you can see over here, the speculators in the turquoise, as of December 1st, this doesn't have the most up-to-date data. I think it's about 2 weeks behind. But anyways, it shows 87% of the speculators are, or compared against the 5-year period, 87% of the speculators are net long. That's a large position. And it's even more as of the last reading, which was, I believe, last Friday it came out. So it must have been data as of 12/19. Or 12/20, something like that. And you had one of the largest net short positions by the commercials, which are the hedgers, and then the non-commercials, the speculators, they were extremely net long. And I've talked about this time in and time out. The hedge fund types, they are trend traders, so I don't like following those type of guys, even though these guys, some of these guys make a lot of money, but a lot of these guys, they don't have high returns. So that's something to note. I have right now some calls that I've sold. I think like a 61, not 6, yeah, maybe a 61 in March, 63 and a 64, but they're hedged. And if the prices are to go higher, what I may do is I may just close one of those call positions, and I may just go net short, and then obviously I'll hedge myself by buying an upside call, just in case there's something like you saw in Libya, right? Like a Libyan pipeline that bursts. Now I wanted to look at the OVX. What is the OVX? The OVX is the volatility index for the ETF, the USO. And right now, you could see that, let me go down here. it's been going up, right? This is as of what, 12:34 Eastern time, so it's a 10-minute lag from right now. I could refresh it if I wanted to, but I'll leave it here for now. So it's going up while the price of USO, the ETF, and crude oil, they're going up. So this is clearly a divergence in volatility and the price action of the commodity. Now, that doesn't mean that it's going up today, the OVX. That doesn't mean that tomorrow you're going to see a down move in crude. But it foreshadows a move to the downside, right? Any technical analysis book talks about, hey, divergence between volatility and the indexes. It doesn't necessarily mean that the move is going to happen tomorrow, but there is a good chance that you're going to see a correction in the asset. So that's what I'm looking at. And if the volatility index goes even higher, the OVX, that may be your clue. You know what? Crude's move is done for now. And in terms of seasonality, I follow some of these commodity traders and investors. It's not the best time for crude because just remember, right? It's cold as hell, and when it's really cold here in the United States, you don't drive as much. Like summertime, you drive more. It's not really summer, the seasonality, based on what I remember. It's like when you get to April-ish, that's when you tend to go long crude. But anyways, I want you guys to comment on crude, where you think it's going with the tax cuts, especially from a fundamental analysis perspective. When you have tax cuts, that's usually bullish for the economy. So you may say, hey, that's a fundamental reason why it should go up higher. And also some of the reports that came in from the EIA, right? Decreasing inventories, increased demand, that's bullish. So you're seeing conflicting items right now, or conflicting stories based on some fundamentals and technicals that I'm looking at. Just different sorts of data. The CoT data is saying that it should go down. The OVX index saying that, hey, volatility is going higher. It still is going up. So that is a red flag. But then on the other hand, the EI reports were bullish from last time I saw. Tax cuts are bullish for crude, especially in a rate hike environment. So yeah, you have a lot of wild pictures, but once again, I hold the CoT data to be one of the best indicators out there at position extremes for the commercials. Anyways, guys, tell me what you think, and I'll talk to you later. All right, thanks. Bye.